Both equity and bond markets traded lower in November. Firstly, we saw that the Federal Reserve announced that it would buy 600 billion worth of government bonds. This was in line with market expectations, and we saw some move back in the gains that had been made in previous months in expectation of this announcement. Also, risk aversion crept back into markets as a result of the Eurozone sovereign debt crisis. Emerging market equities also traded lower, particularly in China, as a result of concerns that Chinese policymakers are going to change their policy stance from a pro-growth policy to more fighting inflation, as inflation has moved a lot higher there in the last few months. Government bond yields in France and Germany also moved higher, indicating that government bond portfolios would have made losses in November. The sovereign crisis has impacted many markets. The first would be the peripheral bond markets, where first of all we saw the yield on the 10-year Irish government bond move up as high as 9%. We also saw the yields in Spain, Belgium, Italy and Portugal move a lot higher. The euro has weakened a lot. It has moved back towards the 130 level against the dollar, but has also weakened against sterling and the yen. Equity markets then have also sold off as a result of the flight to quality and people trying to hold safer asset classes. We saw much better data coming out of Germany, so GDP growth in the third quarter was much stronger than people had been expected, and they also saw that the recovery in Germany was moving from the exports also into the domestic demand market. Leading indicators in Germany have also continued to move higher. Business confidence, as measured by the IFO Institute, is back up towards 2005 levels, so indicating that growth will remain strong there. There was also expectations of a change in stance from the ECB, where they thought that they could ring-fence the Irish banks and provide liquidity to them separately. They're the most reliant country on ECB funding at the moment, and by doing so it would allow the ECB to move liquidity away from the rest of the banking system and hence start to increase rates towards the end of 2011. However, when the ECB met in December, it ruled this out as it extended its liquidity programme on to the end of 2011. Going into December, we would expect volatility to continue, particularly as trading volumes are likely to decline a lot into the year end, which is normal at this time of the year. However, going into 2011, we think that the companies are well set to make gains. We see that valuations are quite reasonable. Companies are holding large cash balances, which will facilitate increased dividends and merger and acquisition activity. Corporate profitability seems to be quite strong as well. But however, we do think that some of this will be offset by the volatility as a result of concerns about high debt with governments and also with consumers.